our Treasurer in New South Wales, Matt Keane, has said that Treasury figures say that the half of all owner-occupiers sell their home within 10.5 years.
Okay.
So, and most first home buyers likely to sell even sooner. So they've got a big pitch. They want first home buyers to take this option up. And just a couple of quick things in terms of indexing and land values going up. If you remember back the $700,000 purchase price example, I just worked out that if land values were to rise by 3% per annum, after 10 years, the annual land tax bill on that property would go up from $1,414 per year. And after 10 years, that would be $1,762 per year. So, and obviously it'd be gradual. It wouldn't be just be like in year one, it's $1,400 and year 10, it's $1,700. It will go up gradually, but that would be 3% annual increase. If it went up by 5% per annum, after 10 years, the land tax bill would be $2,052 per annum. So, it can go up quite a lot, but I guess in that time you're potentially earning more money, all the rest of it. But, obviously that brings back the amount of years it takes before the ledger is equaled, right? And this is something just to be very mindful of. You might even run your own calculations on this. So put in
strongly recommend you run your own calculations on this. And when you're analysing an individual property, run it by your accountant or someone who's really good with numbers.
Or they've got Excel, those little calculators on Excel. They'll be able to map it out for you and tell you, right, this is how many years you need to sell before to be ahead.
Now, and then put some contingency in there.
Yeah. So it does actually make it very complicated, when you're trying to assess this. But I think the other thing that we need to talk about is the investor option, because the stamp duty option might become much more attractive to somebody, a first home buyer, who is planning to, live in it within 12 months for at least 6 months in order to qualify. And then they're going to move out and rent it. And so
what do you find with this one, Veronica?
Well, this is the thing, isn't it? So you do need to be very mindful. So I calculated which one did I look at? I looked at the more expensive property in this example, which was the $1.48 million property. So let's just say I'm going to buy this property. I'm going to live in it for 6 months within the first 12 months, and then I'm going to rent it out. So in my first year of owning that property, my land tax bill might be $2,392. And then in my second year, assuming the land value hasn't gone up, my land tax bill is going to go up to $8,804.
Once it becomes an investment property.
Because the threshold changes, right? And the percentage changes. So the so what it is, it's still calculated the same land value, but instead of being $400 plus 0.3% of land value, now it's $1,500 plus 1.1% of land value. And that's the tax under this option for investors.